Wait, if you're a UK pensioner, stop everything you're doing right now. HMRC has just sent out thousands of unexpected tax bills, some as high as £2,500, and you might be next. In the next 12 minutes, I'm going to reveal exactly what's happening, why this is affecting so many retirees right across the country, and most importantly, what you need to do immediately to protect yourself. This could be the difference between keeping your hard-earned money or losing thousands to the taxman. Stay with me until the end because I'll share 3 critical steps that could save you from this financial nightmare. Hello and welcome back to Smart Pension UK, where we cut through the confusion and bring you the pension information that actually matters. I'm here to help you protect your retirement income, and today's topic is absolutely crucial. If you're new here, make sure you hit that subscribe button and ring the notification bell because we're covering vital pension updates every single week that could directly impact your finances. So let's dive straight into what's happening with these HMRC bills. Thousands of UK pensioners have been receiving shock tax demands in recent months, particularly since November, and the amounts are staggering. We're talking about bills ranging from hundreds to several £1,000s, with £2,500 being a common figure that's appearing again and again. Now, you might be thinking, why is this happening? How can HMRC suddenly demand this money? Well, the truth is, this isn't actually sudden at all from HMRC's perspective, but for many pensioners, it feels like a bolt from the blue. The root cause comes down to something called pay-as-you-earn, or PAYE, and how it applies to your state pension and any private pensions you might have. Let me explain how this works in simple terms. When you receive your state pension, it's paid to you without any tax being deducted. Now, the state pension itself might be below the personal allowance, which, for the current tax year, is £12,570. But here's where the problem starts. Many pensioners also have a workplace pension, a private pension, or maybe they're still doing some part-time work. When you add all these sources of income together, you could easily go over that personal allowance threshold. Your private pension provider or employer uses a tax code given to them by HMRC. This tax code is supposed to tell them how much tax to deduct from your payments. But here's the critical issue that's catching thousands of people out. HMRC doesn't always have up-to-date information about all your income sources. They might not know about that small private pension you started drawing. They might not have accurate information about when your state pension increased. Or perhaps you started a new part-time job and the tax codes didn't get updated properly across all your income sources. What happens then is that you end up paying too little tax throughout the year because each income source is being taxed as if it's your only income. Then, when HMRC finally reconciles everything, usually through something called a P800 tax calculation or a simple assessment notice, they realize you've underpaid. And that's when you get that dreaded letter demanding the money back. Now, the November timing is particularly significant. HMRC typically sends out these tax calculations several months after the end of the tax year, which runs from April 6th to April 5th. So if you underpaid tax in the previous tax year, you're likely to hear about it around autumn time. November has been a particularly heavy month for these notices going out, which is why so many pensioners are being hit right now. But there's another factor making this worse. Many people who reached state pension age in recent years have done so under the new state pension system, which pays a higher amount than the old system. The full new state pension is currently over £11,500 a year. When you combine this with even a modest private pension, you're quickly into taxable territory. Yet many pensioners haven't adjusted their thinking or their tax codes to account for this. Let me give you a real-world example to make this crystal clear. Imagine you're receiving the full new state pension of around £11,500. You also have a small workplace pension paying you £5,000 a year. That's a total income of £16,500. Your personal allowance is £12,570, which means you should be paying tax on approximately £4,000 at the basic rate of 20%. That's £800 in tax you should be paying each year. But if your tax code on your workplace pension hasn't been set correctly, and it's treating that pension as if it's your only income, you might only be paying a fraction of what you owe. Do this for 2 or 3 years and suddenly you're looking at a bill of £2,000 or more. Now, some of you might be thinking, surely this is HMRC's fault. They should have the right information. And you're not entirely wrong. HMRC does bear some responsibility for ensuring tax codes are correct. But the system relies heavily on you, the taxpayer, to inform them of changes in your circumstances. If you start drawing a new pension, if you start or stop working, or if your income changes significantly, you're supposed to tell HMRC so they can update your tax code. The problem is, many pensioners simply don't realize they need to do this. They assume that because everything is computerized, HMRC will automatically know. Unfortunately, that's not how it works. Different pension providers and employers report information at different times, and sometimes that information doesn't get processed correctly. So what should you do if you've received one of these bills? First and foremost, don't panic. Yes, it's a shock, and yes, it's a lot of money, but there are options available to you. The worst thing you can do is ignore it, because HMRC has significant powers to recover tax debts, and they will use them. Your first step should be to check whether the bill is actually correct. HMRC does make mistakes. Look at the calculation they've sent you carefully. Check that they've got all your income sources listed correctly and that the amounts match what you actually received. If you're not sure, gather up your pension statements, your P60 forms if you have them, and any other relevant documents. If something doesn't look right, you can challenge it. HMRC has a process for this. You need to contact them as soon as possible, explain what you think is wrong, and provide evidence. They're required to look into disputes, although the process can take time. If the bill is correct, or mostly correct, then you need to think about how you're going to pay it. Now here's something really important that many people don't know. If you genuinely cannot afford to pay the full amount immediately, HMRC will usually agree to a payment plan. They call this time to pay. You can often spread the payment over 12 months or sometimes even longer, depending on your circumstances. To arrange this, you need to contact HMRC directly. You can do this online through your personal tax account, or you can phone them. Be prepared to explain your financial situation. They'll want to know about your income and essential outgoings. Be honest and realistic. If you commit to a payment plan you can't actually afford, you'll just end up in more trouble down the line. There's also something called a hardship claim. If paying the tax would cause you genuine financial hardship, meaning you'd struggle to pay for essentials like food, heating, or housing, you can ask HMRC to reduce or delay what you owe. This isn't easy to get approved, and you'll need to provide detailed financial information, but it is an option in extreme cases. Now, let's talk about prevention, because this is really the key to avoiding these nasty surprises in the future. The most important thing you can do is make sure your tax code is correct. Your tax code appears on your payslip if you're working, or on your pension statement. It tells your employer or pension provider how much tax-free income you're entitled to. For most people, the tax code for this tax year should start with 1257, which represents your personal allowance of £12,570. But if you have multiple sources of income, it gets more complicated. Typically, your personal allowance will be allocated to just one source of income, usually the largest one, and your other income sources will have different codes that mean tax is deducted from the first pound. You can check your tax code by logging into your personal tax account on the HMRC website. If you haven't set one up yet, I strongly recommend you do. It's free, it's secure, and it gives you access to all sorts of useful information about your tax affairs. You can see all your income sources that HMRC knows about, check your tax codes, and even estimate your tax bill for the current year. If your tax code looks wrong, or if HMRC doesn't have all your income sources listed, you need to update them immediately. You can do this through your personal tax account, or you can call them. Have your national insurance number ready, along with details of all your income sources. Another important step is to keep good records. Make sure you keep all your pension statements, your P60s, and any correspondence from HMRC. If there's ever a dispute about what you earned or what tax you paid, you'll need these documents to prove your case. It's also worth doing a rough calculation yourself each year to check whether you're paying roughly the right amount of tax. This doesn't need to be complicated. Just add up all your income sources for the year, subtract your personal allowance, and multiply what's left by 20% if you're a basic rate taxpayer. Compare that to the total tax you've actually paid. If there's a big difference, you need to investigate why. So there you have it. Everything you need to know about these shock HMRC bills. The key takeaways are: check your tax codes regularly. Make sure HMRC knows about all your income sources. Don't panic if you get a bill, but do act quickly. And remember that payment plans are available. If you found this video helpful, please give it a thumbs up and share it with other pensioners you know. Subscribe to Smart Pension UK for more updates that could save you money in retirement. Drop a comment below if you've been affected or have questions. Until next time, take care of your finances and stay informed. This is Smart Pension UK, signing off.